Hello. Welcome to the channel, or welcome back to the channel. This is just for entertainment purposes only. It's not financial advice. As some of you may know, I've been working on trying to build up my passive income, and given the market turmoil and the drop that we've had due to this tariff thing, I've been looking for some dividend stocks to buy. And I came across SCHD. Now, I've been aware of SCHD for a long time. It's the Charles Schwab dividend fund. It mirrors the top 100 dividend growth dividend companies or something. It's like an index, and it's a very popular fund. If you go to the dividend subreddit on Reddit, people swear by this. It's SCHD and VU. Uh, and right now it's yielding about 4%, a little bit over 4%. And it doesn't really fit my profile because I'm looking for more aggressive, more 8% range, 8% and above. I'm going to make a video on my latest and greatest idea. But in the meantime, though, I thought I would talk about this because for maybe more of a conservative approach, SCHD might really make sense for some people, and I just wanted to bring it to your attention. Now, historically, SCHD hasn't really been that much of a yield I mean, it's been a good yield monster, but it's never been above 4%. It's always been in these last few years in the 3% range. And this is a function of two things, right? Well, what is just the steep drop in prices recently? Obviously, if Schwab did its job, it's picked solid companies that are going to pay the dividends. So the dividends have remained the same, but the cost to buy those shares of those companies has dropped. And so therefore that would increase the yield. And the other part though is the mix of sectors in the fund. Now, I swear to God, I picked these numbers directly from some articles that I read, and I don't know how they couldn't add up to 100%, but this is just to give you a general idea. Uh, but you can see though, Schwab rebalances once a year, and it uses a specific formula to try to figure that out. It uses the market cap is going to be 500 billion or plus, 10 consecutive years of dividend payments, has certain minimum liquidity requirements. It's got a cash flow to total debt requirement, return on equity, a dividend yield, and a 5-year dividend growth rate. And I heard somewhere or read somewhere that the projected dividends growth of the stocks that are bought is like 10%. So if that's true, that means that this dollar plus dividend right now will go up by at least 10 cents in the next year. And if your dividend's going up 10% every year, pretty quickly you could start making some decent money on it. Also, the 100 highest yielding qualified components uh, cannot have more than a 4% weighting, and no sector can have more than a 25% weighting. Okay, so having said all that, what they did recently is they dumped financials. So the financials dropped and they boosted energy. I think this is where a lot of the dividend increase is coming from because energy stocks have been really hard hit. Right, energy stocks have been really hard hit. Mainly looking at oil, it's taken a beating. Some oil stocks like Oxy. Now, Oxy isn't in. Hold on. I just exported this today. So let's take a quick look. So in here you have Chevron. So hold on, let's take a look at Chevron. So Chevron from like the peak back just at the beginning of April, down to let's say where we are right now, it's still down over almost 18%. Whereas a lot of other stocks have recovered, but the energy sectors, I mean, hasn't really recovered that well. And so I'm making this the point because um, if these energy stocks are still kind of down, their yields are higher than what they were when uh, when Schwab created the portfolio, right? Schwab rebalanced sometime around late March when the oil and gas, the energy sector was up here, and it's gotten hammered. All right, if you look from here down to here, the XLE, which is the Standard and Poor's Sector Fund for Energy, it's still down 14% or so. If we look at the consumer defensive stuff, depending where you look, I mean, look what it did. I mean, it basically is almost back to where it was. This is the peak. This is right before the tariffs were announced, and we're back to here. So it's down 1%. Okay, uh, so this is kind of why the yield is so high, is because energy's in there and energy's still beaten down. I'm only bringing this up so that you're aware of what you're buying. I think it's very important. Now, I'm not against energy because I recently on Reddit, I posted asking about energy. I mean, I hopped onto the value investing section over the weekend. I asked, I know oil's getting hammered, some pricing recession, right? Because some people are saying that oil is going to go down to $40 a barrel. I mean, it just depends how bad this gets. But I was asking because I am looking into energy. So I'm not against energy. It's just that you need to be aware that energy could continue to drop. And if energy continues to drop, because it's heavy weighting here, SCHD could get hit, right? But if you're a long-term investor, which is what this would be good for, then you could kind of possibly wait it out. I mean, the good thing is it's got also consumer staples at a pretty high rate. So that's good. Healthcare, financials, financials should, I guess it's a balancing act, but financials are going to, benefit hopefully from lower interest rates that will help them. But at the same time, given the possibility of recession, there's going to be a lot of defaulting, this and the other, and that could create some losses for banks. So maybe it's a mixed bag, and I'm not a financials expert. Well, I'm not an expert in anything other than just rambling on these videos that nobody watches. But anyway, so that was one point I wanted to bring up, was just be aware of the energy, be aware, okay, we're at a historic high for the yield, but that's partly because I think of the energy component of this fund. The cool thing though, it's got very low expenses. It's got very like 0.06% of expenses ratio is pretty decent, and it's quite popular. So I don't think it's too bad if you're just understanding of the long term. They have a long term horizon. And the one more thing though is the following. Here's Altria, MO. I happen to own this as an individual stock as well. But you'll see that July of last year, 2023, it was 94 cents per share. July, starting, sorry, okay, hold on. Starting October that year, it bumped up 4 cents. Here, October 10th, 2024, it bumped up another 4 cents. So within this year, MO is going to raise its dividend. I don't know how much, but my point is though, is that even though right now SCHD is a $1.04 dividend, these 100 stocks that are in this portfolio could be bumping their dividends at any time this year, and so that could change very quickly, possibly. I don't know the timeline of every one of the 100 stocks in this portfolio, but I wanted to point out that there's a possibility that the dividends could be increased quicker than you think. In other words, you don't have to wait exactly a year from now. It could already start increasing throughout the year. Uh, it's probably negligible in the big scheme of things, but I just wanted the grand scheme of things, but I just wanted to point that out. And finally, just for some comparison, I threw it into this comparison for SPY and SCHD last 10 years. I used it with DRIP, so dividend reinvestment plans. In other words, all the dividend income is reinvested back into shares. SPY itself actually also gives off a dividend right there, about 1.26%. I don't know if that's currently the accurate number of the forward yield because it's 4% now. But you can see that SPY has outperformed SCHD by about 40%. So if you put 10 grand in SPY, 10 grand in SCHD 10 years ago, you're about 4 grand ahead. But keep in mind though that SPY has a lot of tech in there that SCHD does not have. So obviously the market's ripping when Nvidia is on fire, it's going to boost its return. But as a more defensive investment, SCHD is a better defensive investment. And if you're somebody who's just maybe not as aggressive or don't want to put all that at risk, then SCHD would definitely be much more of a conservative play. That still over time will help you build up a dividend income. So that's about it. Once again, not financial advice. I just thought it was interesting to share this. I think this would work for some people. And that's it. Good luck. Invest safely.